Welcome back after that short break. As we face a complex macroeconomic landscape, one pressing question investors are asking is how to position their portfolios. Should we focus on secular growth stories that promise stability or take calculated bets on cyclical stocks that can thrive in a rebound? The Nifty is currently trading at a price to earnings ratio of 21, which, while not cheap, indicates fair valuations in a market filled with opportunities and risks alike. With global uncertainty persisting and India's domestic growth story evolving, the choice between secular and cyclical investments has never been more critical for portfolio allocation. This session brings together a panel of industry veterans who will guide us through this discussion with their expert insights. We have with us Mr. Manoj Bahety, co-founder and portfolio manager at Carnelian Asset Management. With over 2 decades of experience in financial services, Mr. Bahety has worked with marquee institutions like Edelweiss Securities, Morgan Stanley, and RIL. He is known for his differentiated non-consensus approach to research. He pioneered forensic research, popularly referred to as analysis beyond consensus, the ABC research, and he's a member of the CFA Institute's global committees. Mr. Manoj also champions health and fitness, having run multiple marathons over the past 8 years. His unique blend of analytical rigor and disciplined personal growth sets him apart as a thought leader in the financial ecosystem. We have with us Ms. Geetika Gupta, Senior Fund Manager at ICICI Prudential AMC. And Ms. Gupta has over a decade of experience in investment research with a keen focus on BFSI, consumer, and technology sectors. Prior to ICICI, she served as Vice President at First Voyager Advisors, managing the fund's investments in Indian equities. Ms. Gupta began her career at Lehman Brothers and later worked with Morgan Stanley Singapore in investment banking. An IIT Delhi and IIM Ahmedabad alumnus, Ms. Geetika combines a sharp academic foundation with practical investment expertise, and her ability to assess high growth opportunities with a long-term view makes her a trusted voice in the industry. And we have with us Mr. Madanagopal Ramu, Head Equity and Fund Manager at Sundaram Alternates. With over 14 years of experience in the Indian financial markets, Mr. Madan manages an impressive AUM of rupees 3,100 plus crores. He joined Sundaram Mutual in 2010, quickly rising through the ranks to become head of research in 2015 and actively managing funds from 2016. A qualified cost accountant and a management graduate from BIM Trichy, Mr. Madan is known for his sharp analytical acumen and ability to navigate complex market dynamics. His focus on identifying emerging opportunities in the equity space has delivered consistent results for investors. And this session will be moderated by Mr. Neil Borate, who is the personal finance editor at Mint. Mr. Neil is a graduate in law and economics with a postgraduate diploma in investments from the University of Birmingham, UK. And Mr. Neil started writing about personal finance in 2016 at Value Research. After a stint at a fintech, Mr. Neil joined Mint in 2019 as a mutual fund reporter. He was made deputy editor in 2022 and subsequently promoted to the role of personal finance editor. He has also co-authored the book, The Big Bull of Dalal Street on Rakesh Jhunjhunwala, one of India's most successful investors. I now invite Mr. Neil to steer this exciting discussion. Mr. Neil, it's over to you.
Thanks, Aishwarya. This is probably the most pivotal question in the markets because if you get this trend right, this determines your success or failure over the next cycle. Now we have quite a few questions to get through. So what I will do to optimize for time is open up each question and then move to the next. So only if you differ with the answer given, please also add your inputs. Otherwise, that's how we'll cover the entire list of topics that's given to us. So let's begin with the definitions. When we say growth versus value or secular versus cyclical, what exactly do we mean? How do we define it? Who would like to first address that? Manoj, please go ahead.
Yeah. Hi. So good afternoon, everyone. And in fact, it's pleasure to be on this forum. And thanks, Aishwarya, for the introduction. So let me just start with secular versus cyclical opportunities. or secular versus structural trends. So our view here is that in essentially in a structural growth market, one should always focus on the structural trends. Secondly, in uncertain times like this, when there is a lot of volatility in the market, these uncertain times gives a very good opportunity to capture structural ideas. So let me just ask a question back to you and audience, that if you can capture, let's say, a cyclical idea which can give you a potential upside of 25, 30, 35% over a period of next 12 to 18 months, vis-a-vis a structural idea which is available at a reasonable valuation right now, and which can give you a power of compounding, let's say, of 15 to 18% over last 15, 20 years. So my call will be to pick up the structural trends, to pick up those structural stories which are reasonably placed from the risk and reward perspective, like which are available at a reasonable valuation and which delivers a reasonable growth to the investors. And if I look at the various structural trends, definitely there are like cyclical issues, like there is a quarterly earning disappointment vis-a-vis expectation. There are global geopolitical issues. There is a kind of tariff war which is going on globally. Every day we are hearing a new noise, and which is creating a volatility in the market. But within this volatility, I think it also create opportunity to capture those structural trends or those structural names and live with them peacefully for next 5, 10, 15 years. So I am in the camp of the structural ideas vis-a-vis cyclical ideas.
Sure. But Manoj, in terms of defining them, could you lay out some parameters? Is it the volatility of earnings that separates the two categories? Or if there are certain sectors that by definition are cyclical, like capital goods, if you could just give some examples.
See, I would say over short term, most of the sectors are cyclical, even like the consumer names. The way the urban consumption have taken impact, the way the consumption has slowed down, whether it is impacting the structural trend of those names, even like we have invested in various CDMO names. Few of the quarter there can be a delay in shipments, there can be delay on the customer side, there can be a delay on the factory ramp up, whether we call it as a cyclical factors. So definitely few of the sectors which are like essentially commodity linked sectors like metals, oil and gas, where like your destiny is not in your head, neither you can determine the prices of raw material nor you can determine the prices of finished good, you are just a price taker. So these are essentially commodity sectors. There are experts who can play the cycle. But other than that, in a market like in India, whether you take pharma, CDMO, consumer, capital goods, there are structural trends if one looks beyond short term cycles.
Okay.
Yeah, just to add to
Yes.
that, I think just thanks Manoj for laying it out. But I think you've mentioned like the right thing, right? Like basically, it's a very gray line between what is structural and what is cyclical, right? Because even sectors like consumption, and there are various legs within consumption, right? Be it real estate, services, products, consumer durables, consumer FMCG, all of them are cyclical to different degrees. So, I mean, without basically compartmentalizing the market between what is value and what is growth, I think, basically we need a combination of both for stocks to do well. Growth without value, even if you're capturing a high growth name, but it's trading at a very high valuation, that doesn't, generate alpha. Similarly, at the same time, if you're going for a value stock, but, there's no growth, it might end up being a value trap. So, you need a combination of all. You need growth, value, as well as a great business. The business should have some right to win. If you get a good combination of all three, that's basically what we sort of focus on, instead of really looking, saying that okay, now growth will work or now value will work, and accordingly let's reorient our portfolio. That is not the approach that we take. It's more bottoms up and looking at the earnings growth with the valuations for various stocks and sectors.
Okay. Madanagopal, if you'd like to
Yeah.
add the definition. Yeah.
Yeah, as I think Manoj put it, there is this thing like as much as you want to think there is cyclical and structural. I think everything is cyclical. It's the time zone of how long the cycle remains, and that's where the difference comes. If you look at, there are certain, if you say how you define a structural story and how you define a cyclical story. A structural story, in our experience over last say 15 years, we can give examples taking a sector and telling you between these, within the sector, these are all structural and these are all non-structural. Let's take banking. Let's take banking or NBFC. What an Bajaj Finance could do, what a Cholamandalam can do, it's not something what a PSU bank can do, or even what HDFC Bank did for so many years. It's not something that your PSU bank can do. So what really Bajaj Finance did, or what really Chola did, these are run by amazingly great management or promoters, right? They started with one business, that time was say X. They kept growing, but they never let down the growth. They kept adding the TAM continuously. They kept adding the TAM continuously to the extent that today we are in Bajaj Finance with a 4 lakh crore loan book. We are still talking about 25% growth. So at 1 lakh crore, there was a doubt whether this company can grow 25%. At 2 lakh crore, there was a doubt. At 3 lakh crore book also, there was a doubt. Even at 4 lakh crore, we are still saying he will still grow 25%. So what really changed in this? The ability of the management to continuously identify adjacent areas or new areas and keep adding the TAM and execute it. Same thing done by Chola. While on the other side, if you take a PSU bank, they just depended on corporate as a only area of growth, which went through a cyclical period of up move during 2008, 9, 10, 11. And then when the corporate loan book started degrowing, these automatically become cyclical stories. And then the growth saturated. Probably once the corporate leverage starts picking up momentum with private capex, hopefully it is not still happening. All of us want to happen, but it is still not happening. Probably they might remain cyclical growth story for 2-3 years. So I think that's where the definition. I can take one more sector like even within consumption, what a trend can do by starting with West Side and then adding Zudio. Again, it will come to the same point. In India, you are obviously not going to get tech companies like US where it's going to be a structural story for 10 years, 15 years, right? You are going to get companies which are probably 5 years growth story maximum. Sometimes exceptions are these Bajaj Finance, which are 10-year growth stories. But yes, an ability of the management to continuously identify new growth areas to sustain a 20% plus growth and then keep delivering that and executing it is one way of defining structural stories and non-structural stories. There are very rare such companies in India. Probably in a year, if you get 2 ideas, you will be very lucky. But I think everything else can be defined as a 3-year cyclical story or just a 6-month cyclical story. That is the cyclicality that is dependable. And post-COVID, I think the cyclicality just increased tremendously because companies came back of COVID in different period and delivered growth. And we are seeing the problem of that, right? Not almost all the sectors now come down back to the base in terms of expectations. So that's how we internally look at structural and cyclical stories and find them.
I'm going to segue a little bit into an area a question that actually Devina Mehra raised in her book recently, which is the issue of forecasting in a DCF or any other kind of method. It's very difficult, she says, to forecast valuations beyond, let's say, 1 or 2 years. Even the management doesn't know how the company is going to pan out in the long term, 10, 15 years. So in that context, is it even possible to identify a secular stock? As in, does that present a challenge?
You are asking me to start with this?
I'm opening it up to the panel. Anyone can take it.
Okay, so I'll start probably when others join. If I have an additional point, I'll come back probably after that. See, I think first point is I think getting into DCF for every stock is actually probably a misnomer. I feel that although we have all studied about DCF as a methodology, very sound, but as you said, it suffers from the predictability point of view beyond a particular point. Your ability to put numbers beyond 2 3 years. I don't think you need to project sitting today beyond 5 years. I don't think that much is expected from the fund managers to create value. I think today, if you can project any business beyond 2 years itself, you can create a difference between expect. I'm not talking about the value zone, whether it creates value or not. That depends on what is the valuation of the stock. But for you to say that you have a differentiated growth path compared to what the sell side is having or not, I don't think you need to think beyond 2 years. I think most of the sell side will try to get the 1 year number right. Maximum 2 years to an extent. I think broadly 2 year numbers keep getting revised. This year is a great proof for it. From a 16% growth, we have come down to 7% growth. So it's a great proof that the consensus is always not right, and most of the time it goes wrong. So for you to get a structural story, I think most importantly, what is important is where are we in the cycle of that particular company's growth in that growth engines. So that is very important. Like for example, I can talk about Unominda as a very different sort of company. Auto anchors are not known for growth, right? I don't think in many auto anchors after a brief period of growth. But Unominda again comes back to the same point that I mentioned. This company will keep on getting you new products. And they have devised their business in such a way they will form part of the high growth engines of the market. So now if you break it and then see, you will get at least in industry growth, plus you will get the content per vehicle growth of around 5-6%, and then new product addition will add another 5-6%. Basically, if you find enough number of points adding to each of these three zones of growth that the company is creating, for you to say that this company, irrespective of auto sector growing in double digit or not, or even if they grow in high single digit, this company can grow at 19-20%. And then when you observe the valuations are somewhere closing, it will not available at a discount to overall value, right? Market valuation. So probably if it comes closer to the market valuation at some point of time, you probably look at a great value in front of it. So we approach most of the structural ideas also from that framework. Probably some of these ideas are at the end of their growth cycle and may not be able to continue to grow at the pace at which they probably delivered the last 4-5 years. But I don't think you need to come down to DCF to come to a conclusion in these. Most of the time they get overpriced when they are at the peak of the valuation. Best way to judge whether value is left or not is to say that whether there is a lot more people who are turning positive on the stock and it's becoming, mostly I say, you enter the stock before it gets into MSCI and you exit the stock after it gets into MSCI, because by that time most of the flows would have happened and the stock valuation would have got identified. So this is one way of looking at it. I think DCF is a great technical tool. Using it without paying attention to flows in the market and buys and sells of the market in that particular stock can make you make mistakes.
Okay. Geetika or Manoj, would you like to add?
Yeah. So I think DCF as a tool works more for companies which have a high predictability of business. What that means is companies which have a strong competitive economic moat and where the longevity of the industrial growth is quite high, right? So it works more for those kind of stocks. But having said that, the moat and the longevity also keeps changing, right? So for example, for a company like DMart, where you would think it's a structural story and growth, you can predict it for 10 years. But as the environment changes and as new competition comes in, maybe in the form of quick commerce, which happened in the case of DMart, it is not static. The assumptions which go into the DCF, growth, profitability, all of that, nothing is constant. All of that constantly evolves. So to that extent,
Because therefore, is the margin of error bigger in a structural name because there you're paying a higher premium for those earnings?
So margin, see, every valuation has to justify the ROE and the growth rate that it delivers, right? If the growth rate is coming down, or if the profitability is coming down because there's a new competition or a new business model which has come and attacked the existing business model, at that time the valuations will not sustain, right? So for a stock which is trading expensive, so if there's an expensive stock but you can't justify it saying it's a structural story if there's no growth, right? Or the profitability is coming off. For those valuations to sustain, the profitability as well as the growth rates have to sustain. So it's never static. It's never. It's not really you can just buy great businesses, secular stories, and sit. You have to constantly evaluating what's changing in the business environment to also make sense of the valuation. So secular stories, we've seen a lot of them go through challenges in the last couple of years, especially where newer competition has come in.
Okay. Manoj, you want to add to this or?
Yeah. I would just like to add, I think both of them have covered pretty well. Only one thing I would like to add. I think, unlike common sense, it is easier to predict long term vis-a-vis short term. And in DCF calculation, even if anybody's model, if you see, 60 to 70, 80% value comes from terminal value. And what is terminal value? It is not just putting just some number in denominator, then arriving at a number and feel happy about it. Terminal value is the outcome of the quality of management, quality of business, how business is placed vis-a-vis competition, how business is growing over long term. Let me just give you an example. I worked in hardcore business with Reliance Industries, and there I used to run cash flows of refining business. And our target was to reach 10,000 crores that time within a certain time frame. And we used to do a monthly monitoring of that. Despite of having all the ingredients with me, unlike outside sell side analysts, including prices, production, and all those numbers, monthly number used to be off by a huge percentage. Still, we comfortably crossed 10,000 crores ahead of the time schedule. So I would say, if even if you take an example of India, if anybody says that during Amritkal period, India's GDP is likely to grow from 4 trillion or 3.8 trillion to 28 to 30 trillion, I would assign a low probability of him going wrong. Maybe like he may go off by 1 or 2 years, but we will be there. But if one has to do a forecasting, that's what the GDP is going to be next quarter or next year, then the variation can be much, much higher. So my call will be, rather than just focusing on numbers, just focus on the drivers which goes behind those numbers, which are like a mix of qualitative and quantitative factors, which I mentioned: quality of management, business, moat of the business, and the competitive scenario.
Okay.
I'll just take a minute just to add to that. Actually, DCF works as a wonderful tool to identify what is getting mispriced, right? So if there's a stock which has not been able to deliver in the near term and the valuations have crashed, right? If you look at the DCF, that will tell you, the growth rate that the street is factoring in is very low, right? Because of the recent past, right? So then you can actually take a call that, when you build more reasonable growth rates, which the business is actually, which has the potential to deliver, then you get to know the mispricing a lot better. So DCF as a tool works great the other way around, where you get to know what is, on the way up as well as on the way down, what is getting mispriced.
Right. Okay. Now there's been a heated debate in the market about the valuations of large versus mid and small caps. Does this connect to the topic at hand, which is the rotation from cyclical to structural? Would somebody like to take this up?
Yeah. So probably I'll take it. See, this is an interesting debate. I'll throw what we learned looking at mid and small caps very closely, particularly mid cap. I'll take a lot of people ask me about whether mid caps at this valuation should be a set zone. If you look at the long term chart of mid cap versus Nifty, the way the premium increases and decreases like a triangle, it's never proven wrong. I think every 4 years this keeps happening, and how much ever you try to be aware and saying this time the cycle can be different, probably the longevity of the cycle can change, but I think the cycle goes through this phase of getting over too much attraction and fall. I think you need to be very conscious about it when you're trying to decide particularly if you are in a passive investor or a diversified sort of a portfolio investor in the mid and small cap space, because you benefit from the upcycle, and you also have to go through the pain during the down cycle, irrespective of it is a function of flow most of the time. Sometimes earnings helps you, but most of the time it's a function of flow, which we are seeing. But when you look at the mid cap, it's an interesting space. Mid cap is like a railway junction, in the middle of India, somewhere like a Bhopal. Trains which are coming from becoming a large cap to mid cap to small cap, which is like a derating stories. For 10 years, they are not growing, and they are also sitting in that. And trains which are moving from small cap to large cap is also midway, they are sitting in mid cap. Now, unfortunately, market tries to look the entire universe as one and say entire mid cap is either buy when the flows are happening, sell the entire mid cap when the flows are weak or when the earnings is weakening. Actually, it is not. If you look at Q3, when the Nifty's earnings growth is only 5%, 40% of mid cap universe out of 150 mid cap index, if you take, have delivered more than 15% earnings growth. This number has come down from the peak compared to last 4 quarters. It has now come down, but still it is almost 40 to 50 companies which are delivering in mid cap out of 150 index, which are delivering more than 15% growth, which is 3 times the growth of large cap. But there are another set of 60-70 stocks where the growth is less than 10%. What worked really well in the last 2 years? Because of cyclicality, the other bucket worked really well because they were cheap and the mean reversion happened really well. So you made money out of mid caps from completely non-structural. Structural stories also participated, but if it is more predictable stories, it has not probably participated. It is mostly wherever there is surprises that participated. So a lot more of the momentum narrative based, the bucket which I am referring to, the bucket where it is heading down and temporarily it got the benefit of doing well after the COVID. That bucket got overpriced at a point of time. So I think this differentiation has to be kept in mind. So when people look at mid cap as a cap curve and invest into diversified funds or invest into passive investment into it, they should probably understand that there is 2 types of buckets within this mid cap universe, and according to which bucket you are in at what cycle will depend on what return you make. Otherwise, I think from a growth engine perspective, looking at what is happening in Nifty, so Nifty's problem is not valuation, Nifty's problem is earnings. And for a 5% earnings growth, how it will justify an FII to come and buy it? Imagine if you are getting 5% US Treasury yields and then you have a risk of currency depreciating. I think FIs will not come unless something dramatically happens to the dollar call.
Basically, even 21 is not justified.
Yes. Unless we come back next year and say, no, Nifty's earnings growth is now going to be 15%, which is what the expectation at the beginning of the year was. Now it has come down to almost closer to 5-6%. So we feel that if there is no safe zone in the market across the cap curve, you can say you can hide into Nifty, probably because Nifty has not worked for 3 years. So 70% of Nifty stocks have not worked for 3 years. So you can hide there. But if you really want growth, and with the way market is crashing today, and keeping in mind that there is a bucket of mid caps, small caps, which are still growing and growing substantially better than the Nifty. At some point, if you find valuation, you have to get in. With a 3-year view, next 1 year, I think all nets are going to be chopped off. Because as much as it went up, everybody is trying to cut it down. But I think if some investors who can take a 3-year view, they will get a good bargain on some of these mid and small cap names, which have potential to deliver a 3-year of very high growth compared to Nifty.
Very well put. Geetika,
Yeah. So I think let's look at what led to the rally, right? Like if you look at last 4 years on the base of 2019, the earnings growth was very healthy, right? And it was very, very broad based. So if you look at just a small cap, the earnings CAGR was close to 40%, right? And that drove the sort of returns that we saw in the small cap and similar in mid cap. And this is not just coming off a low COVID base. Even if you look at the period prior to that, which was basically 2014 to 19, right? Even then, I mean, if anybody were to take a guess of what was the earnings growth for small cap, it was literally 0%, right? So it's coming because of a low base, not only COVID base, but even prior to that. And because of this 40% kind of earnings growth, we saw the kind of rally we did. But today, as we speak, I think a lot of it is in the base. The base effect has sort of normalized between small cap and large cap. Can we still get another 30-40% growth? I think the jury is still out. But I think because the base has normalized, expectation of 15 to 20% growth would be more reasonable. So because the growth rates for a lot of stocks will come down from 30% plus levels to closer to 15% or 20%, the derating is something which is taking place accordingly. So not don't want to paint everything with the same brush, saying that the small caps are expensive. I think for each stock, each sector, we have to take which are the companies or sectors which can still deliver maybe 15-20% growth, which are the companies where they can't basically deliver even 10% growth, and accordingly one has to take a call. But we are definitely away from that period where the discoverability was an issue, right? So
Right.
3 years back when we bet on manufacturing, there was a big difference in the market. People had given up on manufacturing. Consumption names were very expensive. There was low discoverability on manufacturing. That we think is largely done now. Manufacturing is also expensive. So the stocks which are expensive have to justify those expensive valuations. And if they are not able to deliver that sort of earnings growth, there will be a continued derating. So I think the base is normalized, and accordingly one has to be careful, because earnings growth will not remain as high as it was in the last 2-3 years.
Right. But do you agree with Madanagopal's assessment that in large caps, the earnings growth is just 5% and therefore even 21 P looks expensive?
So earnings growth, again, if you look at Nifty as a basket, again, maybe 5% is the number. I mean, we always take a bottoms-up approach. As I said in the first question as well. Basically, you need a combination of growth as well as valuation. So just valuations of sectors which are not able to deliver growth, which can only deliver 5% earnings growth. I think I would agree with Mr. Madanagopal that it's very difficult to get valuations in those sectors. But some sectors, like for example, even within consumption, right, like we are seeing a big difference. Like services sector is doing much better, right? Maybe the FMCG companies are not able to deliver those sort of earnings growth, but just because of shift from unorganized to organized, retail sector is doing very well, right? And some of these stocks have done really well, and which might continue. So wherever there is growth in large cap, even in maybe in the other market capitalized stocks also, accordingly we will see the movement in the stocks. But having said that, the 10 to 15% earnings growth in an uncertain environment, whether large caps are better placed or the small caps, that's basically the key debate.
Okay. Manoj, a slightly different version of the question to you. So if you think back historically, we've had very distinct phases of growth versus value. So we had the 2016-17 boom in value. Then we had 18 to 20 where growth took over, the breadth narrowed massively. And then post-COVID, again, value came back with a bang. So are we at another inflection point where we're going back to a 2019-20 kind of or 18-20 kind of market?
See, I think if you are investing in a market in India, I think you cannot live without the growth element. Just buying a value stock where the growth element is missing. See, if you look at India, right now, even at the subdued GDP growth, your nominal GDP growth is close to 10%. Your corporate profit has to be grow much faster than 10%. Like if I take corporate profit to GDP ratio right now, it is at 4.8%, which is last 15 years high. So I will be really surprised that this 5, 7, 8, 10% kind of corporate earning CAGR will be a sustainable growth for a country like India. In fact, one more data which I would like to add, if I look at the overall incremental GDP growth of the world, and on a purchase price parity terms, India is contributing almost 20% of the incremental world GDP growth. So we are in a in a country which is known for its growth. And here, if anybody is putting money into stocks, he will make money only, or he will compound the money only by growth element. The value part also comes in, that you should not pay any price for the growth. You should be cognizant of the fact that there is a risk and reward in the investing. What is the margin of safety when you are buying the growth? If you are paying any price for a lower growth or for a reasonable growth, then it can lead to a subdued growth. And on your topic of mid cap to large caps, I would say that every large cap used to be a mid cap at some point of time. So in this country, in India, it gives enough opportunity to identify those mid and small caps which has potential to be large caps of tomorrow. So if you can just focus on slightly medium to long term, I would say that value versus growth debate tilts in the favor of growth stocks available at a reasonable valuation, where businesses have a large TAM, where management quality is good, balance sheet is good, and business is delivering decent ROEs, ROCs. If you can pick up those names, whether it is in mid caps, large mid caps, and even in some large caps, it doesn't matter over a long period of time.
Thanks, Manoj. We are sorry.
One additional point that I had on the approach towards, so how do you really, so where is the gravity shifting? That's a very important point that we keep debating, right? The gravity last 2-3 years was like, if the more of a value sort of an gravity shift. So in your portfolio, if you had approached anything with the view that it's cheap and there can be some positive surprise, that worked. And now we are slowly shifting to a period where we need some bit of a conviction growth. It can be even smaller, but still it matters. In that context, in large caps, as much as there is a problem in terms of growth, but it can always be looked at from a Dorcas theory. They may not be the winners, right? They may not be the winners from a growth perspective. But in a Dorcas theory, you don't make money by betting on the number one stock all the time, because the bet against the stock is very low. Therefore, in a total sum basis, the guy who's betting on the number one horse is not going to benefit. The guy who's betting on the second or the third, and if the third becomes second, he is going to get more money than the guy who's betting on the number one horse. From that, bucketing can see some that can be a bucket where you need to be a little bit more focused on, because the growth itself is going to be constrained for many. And if you already want a stock which so far till the growth came, till the money kept on flowing, you could have said where stock is trading at 30 times can go to 40 times, 40 times can go to 50 times. Now, where really does the bottom lie? Whether the 40 times can come down to 30 times, even if the company is growing at 30%, and if the valuation drops from 40 to 30 because the overall mid cap valuation is coming down, then you're left with no return from that stock. So that is going to be sort of a challenging thing, because we also basically believe in growth as a basis to invest. But this is the challenge we really face today, that we can talk about growth, but they are sitting at a very high premium valuations. So where it stops? Does it stop with a 10% correction or a 20 or a 30% correction? Then the growth is taken away from you. But I think slowly we are getting into this inclination. We have to look at certain companies which are growing even between 10 to 15%. If they, by luck, surprise you this year, then they will be the ones which will create alpha for you from this year. And this may not be the entire portfolio. I think part of the portfolio needs to be allocated to such buckets also.
Fair enough. Great. Thank you so much, Madanagopal, Geetika, and Manoj. We are at the end of our time. I'll now hand it over to Aishwarya.